Here's a question that keeps most people awake at night. How will you pay your bills when you can't work anymore? Social Security barely covers rent, and most Americans have less than $100,000 saved for retirement. But what if I told you that just $300 per month could create more than a $5,000 monthly income stream that pays you for life? Today, I'm showing you the Dividend Snowball strategy that turns small investments into life-changing passive income. Here's exactly what we're covering today. First, I'll reveal the science behind the Dividend Snowball effect and why it's the secret weapon of wealthy investors. Then, I'll show you two powerful strategies with real numbers that'll blow your mind. We'll explore the exact companies and funds that make this possible, including a real portfolio that could generate $5,000 monthly. Finally, I'll share two bonus acceleration techniques that most investors never discover. Before we dive in, let me share something that completely changed how I think about money. When you buy shares of Coca-Cola, you become a tiny owner of one of the world's most profitable companies. Every quarter, Coca-Cola makes billions in profit, and because you're an owner, they send you a piece of that profit as a dividend. Instead of spending that dividend check, you use it to buy more Coca-Cola shares. More shares mean bigger dividend checks next quarter. Bigger checks buy even more shares. More shares create even bigger checks. This cycle continues automatically like a snowball rolling downhill, gathering more snow with every rotation. The companies keep making money, the dividends keep coming, and your wealth keeps growing while you sleep. Strategy number 1, the set and forget approach. Let's start with the simplest method, a one-time investment that quietly compounds for decades. Say you invest $10,000 in a stock like Johnson & Johnson, which has raised its dividend for 62 straight years. Assuming a 6% annual dividend growth rate and full reinvestment. After 25 years, your $10,000 grows to about $301,700, generating $3,820 per year, or $318 a month in passive income. After 35 years, that same investment becomes $1,005,000, paying over $19,300 annually, or about $1,610 a month in dividends. Scale it up, a $50,000 one-time investment would grow to over $5.25 million after 35 years, producing around $8,050 a month in dividends. This is the true magic of reinvested dividends in time. No monthly contributions required, just patience and consistency. Strategy number 2, the monthly building machine. Now let's look at a strategy that steadily builds wealth, a combination of monthly investing and dividend reinvestment. You start with $1,000 upfront, then add $200 every month for 35 years. That's a total contribution of $85,000 over time. Assuming a 2.5% starting dividend yield and 6% annual dividend growth, here's what that could become. By year 25, your portfolio grows to about $143,000, generating $14,480 annually, or about $1,207 per month in dividends. By year 30, it reaches around $207,000, producing $28,038 annually, or about $2,336 a month. By year 35, you're looking at a $293,000 portfolio, paying out approximately $53,124 annually, which equals $4,427 per month in passive income. These numbers include dividend reinvestment, which accelerates compounding and boosts your long-term income potential. This strategy proves that patience, discipline, and consistency, not massive starting capital, are the true drivers of financial independence. The Dividend Snowball Portfolio. Now that you understand the power of the Dividend Snowball, let's build the perfect portfolio to make it happen. The foundation starts with dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years. Some of the most reliable dividend aristocrats include Coca-Cola, with a 4.46% compound annual dividend growth rate over 5 years and 53 consecutive years of increases, Procter & Gamble growing dividends at 6.18% annually over 5 years, with an incredible 69 consecutive years of increases. Johnson & Johnson at 6.0% annual dividend growth over 10 years with 62 consecutive years. And McDonald's with strong 7.4% annual dividend growth over 5 years and 17 consecutive years of increases. Next, add high dividend ETFs for instant diversification. The SPDR S&P Dividend ETF (SDY) currently yields 2.66% and tracks companies with at least 20 years of consecutive dividend increases. The Vanguard High Dividend Yield ETF (VYM) offers a 2.55% yield with extremely low 0.06% fees, making it cost-effective for long-term investors. The $5,000 monthly income portfolio. Let's put this all together into a real-world dividend snowball that could generate over $5,000 in monthly passive income. We'll create a balanced portfolio with Johnson & Johnson, 25%, McDonald's, 15%, Coca-Cola, 15%, Procter & Gamble, 15%, Vanguard High Dividend Yield ETF, 30%. This mix gives us a 2.75% average starting yield and an estimated 5.41% annual dividend growth rate. Realistic based on long-term data. Now, let's assume you invest $300 per month and reinvest all dividends automatically. Here's what happens. After 25 years, your portfolio grows to around $222,200, generating $22,750 annually. That's about $1,896 per month in dividend income. After 30 years, it reaches approximately $406,800, producing $53,380 annually, or $4,448 per month. By year 33, your portfolio hits $591,900, yielding $78,760 annually. That's $6,563 per month. And at year 35, it climbs to $744,800, paying out an impressive $97,530 annually, or $8,127 per month in passive income. These numbers are based on compound growth, dividend reinvestment, and credible long-term averages. No unrealistic hype, just math and time. It shows that a modest but consistent $300 per month habit, paired with quality dividend stocks, can build life-changing income in your lifetime. If you've made it this far, you're serious about building real wealth. Here are 2 advanced strategies that can supercharge your dividend snowball. The first acceleration secret is the payout ratio strategy. Focus on companies with payout ratios between 50% and 60% of their earnings. This means the company shares a healthy portion of profits with shareholders, while retaining enough cash to grow the business and increase future dividends. Companies paying out 80% or 90% have little room for dividend growth. The second acceleration secret is the yield trap avoidance. While high dividend yields might seem attractive, they often signal financial trouble. A company yielding 8% when similar companies yield 3% might be struggling. Instead, focus on companies with moderate yields that have a long history of consistent dividend growth. A 3% yield that grows 8% annually will surpass a static 6% yield within just a few years. You now have the complete blueprint to create a dividend snowball that could generate $5,000 or more in monthly passive income. 2 proven strategies: a diversified portfolio of dividend aristocrats and high-yield ETFs, and the exact timeline showing when your wealth-building journey reaches financial freedom. The most important lesson? The sooner you start, the more powerful your snowball becomes. Every month you delay is another month of potential dividend growth you're missing. As Warren Buffett wisely said, someone's sitting in the shade today because someone planted a tree long ago. The best time to plant your dividend tree was 20 years ago. The second best time is right now. If this video opened your eyes to dividend snowball investing, smash that like button and drop your monthly income goal in the comments. Subscribe if you're serious about building wealth that works for you instead of the other way around. Remember, simplify money, muchify wealth. one smart decision at a time.